Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Hello, y'all. Welcome back for another weekly market recap at an unusual time of day for me. It's not Saturday morning. It's almost mid-afternoon at this point, but I'm having a super busy weekend, so I didn't have time in the morning. And I need to try to record as quick as I can because I'm going to have guests for dinner. So, you know, at a point, I'm going to have to start preparations. Now, without further ado, what about markets this week? They were particularly volatile, especially at the end of the week. We had some movement, of course, and there were a lot of macroeconomic data points. So let's skip through a lot of the initial talks and let's get through the economic calendar as quick as we can. Now, the first thing which came out was ISM manufacturing PMI, which again, another very good result. So, you know, might be the policies implemented by President Trump, but more than that, I think it's this AI build out, which is really reviving the domestic industry of the US. Of course, you should really dig in and see which sectors are participating more and which other are maybe left a little bit in the dust. But, you know, on aggregate, as you can see, another very good print for the manufacturing sector. And, you know, it's kind of reflected even in the ISM manufacturing employment, which, you know, came up starting from basically last summer. And it's, you know, at much more elevated values compared to where it was back then. So, again, another plus for the manufacturing sector. We'll see how long it can sustain. I mean, at this point, I would say, if my thesis is correct, it's going to be sustained up until the point these AI build-out will keep on going, right? Now, we got jobs openings. And it was, you know, kind of a good print. It was above expectations, I think. Yeah, above consensus. Although, you know, there is a funny story with that. Now, if you look at these, and, you know, later on we got NFP as well. But, you know, let's start out with this. If you look at these, you may say, oh, okay, again, another testimony that the labor market is pretty resilient, which, you know, at face value, I think it is. And I've repeated that many different times over the past months, all right? But there is a little bit of a discrepancy there. It's not something which completely disrupt or destroy these theses about resiliency, but, you know, it forces you to look a bit better under the hood, all right? Which is these essentially. If you look at the hiring rate, I mean, you know, since 2022, right? It peaked and it keeps on slowing down, right? And then you look at the quit rate, which, you know, it's not going up. Now, these two should be, you know, these one should go up, right? If companies are hiring more new personnel, like this one instead, the quits, that should go up as well. Because, you know, when people think they can have a better career or a better job opportunity elsewhere, they may be more willing to voluntarily quit their job and find another one, which maybe pays them better wages or gives them better benefits or whatever. And none of that is happening. So, you know, sure, good prints on job openings. Actually, I was reading, it's the first time in a long time, we're talking about months, if not years, that the amount of new jobs created is actually exceeding the amount of appliances or, you know, requests to new jobs. So that should give you the idea that, yeah, the labor market is fine. And there are actually even more jobs than what people are actually asking for. So everything is cool. Yeah, if it is, why, again, companies are not really hiring, right? And why people are not quitting the job to get better opportunities elsewhere, right? Those things are in contrast a little bit, right? And again, if you remember, I think it was even before Christmas, it's been a while, but we were talking about the fact that a lot of companies, they just leave, you know, jobs openings posted to give the impression that they're always, going good, expanding, looking new personnel, but they just post the announcement, but then they don't actually have the intention of filling in that position. So, numbers can be liars sometimes, right? Now, what else? ADP, sure, kind of like the jobs openings, it was going up. So last 3 or 4 prints, all positive, all to the upside. Again, same type of talks we could have had for, the jobs openings, right? Then what? The ISM services PMI, which of course, 54.5. So good, right? Not a lot to say about that. I mean, it's something that has been like that for a while. There's no need to allocate a lot of time to these, but you can just read the paragraph if you want. I'm not gonna dive deep into it, right? So let's get to the meat on the bone for this week. As for the economic data, unemployment rate stayed pretty flat, 4.3, unchanged. All right. If you look at the participation rate, though, see that it's still unchanged compared to April, but look, it's really going down, right? So I mean, if you try to adjust the headline unemployment rate, which is basically flat, for a participation rate which is going down in the same span of time, the reality should be that unemployment rate actually stays flat because those people which are losing their jobs are not looking for another one. And it could be many different things, right? They are so desperate and depressed that at this point they're not even trying. So, or they are so not confident in the economy to provide them for a new job that, again, they don't even seek it. So, when you look at the two together, obviously, if this one is going down, less people are participating, so actually looking for a job, right? Yeah, they don't have a job, but they don't fall in this statistic here. So this one stays flat, although the situation under the hood, it's not as rosy as this one would suggest, right? And then what we got was NFP, which was a huge bit, blowout number, right? 172, which was above the expectations, which were for what, 85. Even in this one, if you look, the vast majority of new jobs were created in leisure and hospitality. I think there was a 55K in local government. Oh, there you go. All right. Healthcare. So the usual suspects, right? This time around, I guess the previous 2 months were revised to the upside. So, it's a little bit of a new thing, especially over the last year or something like that, where, we were used to see, numbers being downwardly revised. So again, if you put all the things together, right? The JOLTS, job openings, the ADP employment report, this one right here, and even, unemployment, although with this caveat, staying relatively flat. At the end of the day, what you may think is, well, look, when should we kind of change I'm talking about myself right now, but when should I change my view of this inflationary period ahead, right? Because if you try to stack all the things together, right, on top of each other, you got more jobs created, all right, NFP going up, all right, the energy situation is not resolved, so oil still particularly elevated as for the price, so everything should scream inflation, more jobs, aka more people with a salary or a paycheck, therefore spending capability, able to chase prices higher and higher, although again, it depends on what type of job you get. But anyway, right? So, but then you look at these and you see that average hourly earnings still, to me, they are still downtrending, all right? And when you look at the numbers of hours which are worked every week, on average, they're still relatively flat after declining starting in 2022. So I'm not really ready to give in on my disinflationary thesis going ahead, right? Which again, disinflationary doesn't necessarily mean that prices will get back to levels they were previously, just that they won't accelerate at the same rate people are expecting, right? Or the same rate they were accelerating at, maybe 6 months ago, 8 months ago, 9 months ago, so something like that. In order to get prices down, you would actually need deflation, right? But nobody wants that, because deflation in the real economy would be deflation in the stock market as well, and nobody wants that, right? So I would be ready to give in on that thesis if you consider an economy like the American ones, which counts how many? 350 million people. So although they are good numbers, right, for NFP, 172, compared to the recent past, it looks like a good number. But for that type of economy, I think, a really good number, a really red hot economy, I would expect a print of 200K, 250K, something like that. Again, I don't think these prints are necessarily enough to make me shift my idea, my bias on a disinflationary period ahead. I know it's hard to conceive because, I say I'm expecting disinflation, then you see CPI over the last 2 or 3 prints, it went up. But, I'm talking about months, if not years. I'm not talking next quarter. I'm talking, the environment, the macro environment, so to speak, all right? Kind of like what we had after the peak when CPI got up to 9.1% and then spent like almost 2 years getting back down toward 2.5, right? So again, of course, with this energy spike that we had for the Iran conflict, is it normal to see a little bit of CPI going up? Sure, but I still don't think it is something sustainable in the long run, right? So I'm not really expecting some sort of a 90s, 70s type of a runaway inflation, right? Then what? We're going to look at the break-evens later on. I guess for the economic calendar, that should be it, right? So let's just cut this part and skip into the charts. Having a look at the charts, let's start out. The usual suspects, the US dollar, or the DXY, should I say. Oh, well, went up, obviously. So again, after, last week, it was a little bit of a sideways action. There was an attempt to pump and then an attempt to dump, and nothing really changed, right? The weekly candle, I think it was a doji or something like that. Yeah, kind of like, right? Yeah. And then this week, finally, we had that move to the upside. So I guess in the end, you could say there are many different ways by which the market can prove you wrong, although you are eventually right, in the sense that 2-3 weeks ago, I said, well, I would expect the DXY to keep on going higher, but maybe with this grindy action, right? And then what? It did nothing for like 10 days, and finally it went up, but not grinding, especially on, Wednesday and Friday. It just pumped straight up. Now, I know if you just look at the candles, it doesn't look like a huge pump, but again, for the DXY, a move like this, I mean, it is kind of relevant, right? So we are back to almost to the upper side of the range. We have been staying and lived in this range for a lot now. And again, if things are like that, I would expect more of the same. Now, sure, 1, 2, 3, 4, 5, 6, we are approaching the same area once again. So naturally, by the nature of a range, you have resistance on the top and support at the bottom. You may say, okay, I'm expecting a bit of a cool off at these levels here. Yeah, sure, maybe, why not? But I'm not saying it should just blast right through, but the disposition, it's to the upside up until the point we reach into these levels, which quite honestly are pretty, we are pretty much there at this point, and then we'll see, right? This is the point where you get back into the same game of, can we break out now or not, right? But, up until the point you don't see a rejection, I would keep on maintaining a bullish bias on the DXY for next week. Conversely, if you look at the rest, what you see is that the euro tanked, the pound tanked, Japanese yen kept on doing the same drifting down, and as you can see even in here, right, it is expected support, right, after the intervention. Did it provide a huge reaction like it was in here? No. So you see why, a drifting market it's always way harder to be bought than a dumping market like this, right? I know it may sound counterintuitive, but again, you want to, if you have, I'm not saying you should everywhere and anywhere, right? Trying to fade or trying to buy a dip, right? But if you have to, make sure you are buying or fading something which is either tanking into a level or skyrocketing into it, right? So some principles always stick in market. I don't know why. I didn't invent it that way, but I'm just observing that, okay? Canadian dollar, it got back to the same support, and we are still here. So again, kind of like the dollar, the DXY, but in reverse. At this point, you should expect, well, a bit of support here up until you're proven otherwise, right? So nothing more than that. Although, you know, one bounce, and it goes up. Second bounce, no new highs. Third bounce, you know, is it safe to keep on buying it? I guess you pick your poison, but it is also true that, you know, a range is a range up until the point it's not. So, you know, let's just wait to see if we can, once again, find support in here, or if we start to live below it, right? At that point, you know that this support is no longer a support, and you will trading accordingly. Swiss franc is basically done the same as, you know, the euro or the British pound. Nothing really, you know, particularly interesting to look at there. The others are pretty much unchanged, like the Chinese yuan keeps on drifting to the upside. South African rand at this point, it's choking. I mean, it's poking at this resistance for the longest time, but at the same time, as you can see, to the downside, still maintaining this trend line. So didn't give in yet. The Indian rupee this week, look at that. It managed to not make a new low. So maybe a little bit of a sideways action, if not a bounce attempt. Of course, the primary target would be this one in case of a bounce attempt. And then we see if we can get back above it and, you know, try to, you know, reclaim this sort of structure right here, right? To try to at least want to shift bullish in the short term. Up until the point we are living below these two levels, yeah, I mean, it's just a bounce, just going sideways, as you know, as he was doing in here or in here, right? So not huge expectations so far, right? The Brazilian real this week, you see it dumped, but again, as we were saying, sure, was contracting, going sideways. There was still this leg up to be filled potentially, and it looks like we are basically there. Can we slip through a little bit lower to the downside? I mean, the bulk of these volumes wouldn't be bad. Let's see what happens from here. But you know, still going up. So I wouldn't call it a huge or definitive reversal at this point, right? The Russian ruble, it looks like it's taking a little bit of a breathe in here after pumping a lot. And the Australian dollar, it's, if you look at that, these type of construction right here, it moved the same as the Brazilian real, right? Goes sideways, tries to go up, reject it, and then it leaves, you know, in between weakness, bounces attempt, but then, you know, failure, and it goes back lower. Same here, right? Goes sideways, up, rejected, a little bit of weakness, tries again higher, it fails, gets back lower. So that would be it for currencies, right? Let's have a look instead at probably the saddest story for the week, which is Bitcoin. Now, I'm going to be honest, all right? I kind of sensed, right? I was kind of sure that these key swing low right here was really the line in the sand, in the sense that, well, I mean, if we lose that, prepare to see it going down, sure. Was I expecting this type of move all at once? No, quite honestly, no. And if you remember, I was looking at this level and said, well, I mean, Now that we are living below this key swing, and we had an initial swing failure, right? A bounce, no new highs, right? In the short term. And then last Saturday, we were basically in here, right? And I said, we are already living below the swing for what? 2-3 days. So massive weakness on side. But even if we dump, maybe, a little bit of support, a little bit of a reaction, a bounce in here. No, sir. The market said no. And we basically went for new lows. We traded below the February lows. So, on a closing basis, not yet, but I think we're there. And the first thing you should say is, okay, this is continuation at this point, right? From the top, right, the market had a leg down, sideways, flagging out, leg down, sideways, flagging out, leg down. Is it? Are we really getting back to where? Zooming in on a weekly time frame. Like this area, it was support, right? It was support in here, and then again in here, and it provided the bounce all the way up here, right? Now we have cleanly denied all this buying activity, and we are back at the same support. So again, would you say another bounce? But maybe, okay, maybe another bounce, but let's hope that's the one, because otherwise, if it is some sort of a dead cat bounce in here, there's not a lot below, up until what, 50K, maybe, but you start to talk really doom and gloom numbers there. So for now, let's leave it at that and say it's significant that we traded below these lows, right? Can we have, a little bit of a situation where these push down got the market really extended, and we may see a little bit of a relief rally, especially, next week throughout the middle of the week, right? Potentially, but it's really hard to find out reasons to be bullish this one at this point. Now, okay, you may say, sure, but this is just the final washout to put in the ultimate low, and then from that point onward, it would be all rosy, rainbow, and unicorns. Look, let's try to zoom out to give it a little bit of a context, right? If it was the same type of dump, right, that we are looking at, if it was in here, right, as we see, for example, in here, right, it is huge dump, all right, or as we've seen in here, right, I would agree. Okay, maybe there is a potential for talking about a capitulation type of low, and then up we go. But the problem for me is the context. When we were looking at these flashes to the downside, it was in the context of a market which overall was trading to the upside. Like the major trend was up. We are looking at these, right, in the context where the market has been down since basically October 2025. So I can't take the same type of fractal, right? Saying, this is how you put in ultimate lows. Sure, if it was going up, right? If it's a washout, right? If it was going up, maybe, but it's not. So up until the point I'm not told otherwise, I would tend to look at it at continuation rather than capitulation, all right? So how far or how much lower can we go? Again, I think 50K. If you really don't have any sort of reaction in here, next step would be, and it's gonna take maybe another week or two, who knows, right? It's always hard to time these things, but I see no reasons, if we are really seeing weakness in here, why we shouldn't target at least 50K, all right? Plus, again, if you want to look at the context, try to look at the entire dump in the context of the overall market. Like this is happening, in a week where everything came back down. The stock market came down, gold down, other metals down, even oil was down. So, if it was just a phenomenon in Bitcoin, again, maybe you could have made the case if it wasn't for, the primary trend. Okay, but everything is down. It's like an overall, a broad, generalized risk off. So, I'm just a bit skeptical, so to speak. Can I be right? Can I be wrong? Sure, I could be wrong, but such is the nature of markets, right? Speaking of gold, let's have a look at gold, which again, all the downside for this week, or the vast majority of it, was made on a Friday. Because yeah, sure, I mean, Monday was down, but then it went sideways for 3 days. So, the real flash actually came in on Friday, all right? And again, I still retaining the same type of levels for gold after we started to really, going to deplete this pocket of liquidity in here, right? At the top, then we worked out the midpoint of this shelf, and then now we are working on the shelf bottom, which would be kind of like in here, right? And it looks like we already closed below. So even with gold, I think it may have another $100, $150 of downside to go. Again, I don't know if it's going to be a slow grind down, right? A drifting down or another flush, but I would think that we need to revisit this area around 4,000, 4,100, something like that. All right. Can we bounce from here? Sure. I mean, yeah, it's the same as Bitcoin at the end of the day. A thing which is going down all of a sudden like that so sharply, can it bounce? Of course it can. Actually, the logic would suggest, as usual, the farther it goes, the weaker it gets. So the more price is traveling away from the current bulk of volumes, right? The more prone or susceptible should be to a pullback. Whether it is, a pullback in the sense, we drop down, so the pullback would be a bounce, or we pump higher and the pullback should be, price coming back down. The logic applies both ways. I don't think gold is as extended as, obviously Bitcoin is. It's not just the different volatility in between the two assets. It's just the way gold is going down. To me, this is looking like classic distribution. If Bitcoin is just, flagging out, we gave it a try, people may still believe that, it was a good buy, and then all of a sudden you got this flash, right? So some sort of a buyer shut off, right? Like in this one, instead, it looks like you had the same phenomenon in here, right? Buyers really gave in on this liquidation event. And then, since this point, middle of April, they are slowly distributing that. So, actually, the more I look at that, the more bearish I feel in the short term. Again, in the short term, right? But again, at the end of a week like this, especially with a Friday like this, you're always kind of in between. Okay, so nasty close on a Friday. You gotta remember that for people maybe in Japan, in Australia, in Southeast Asia, right? They basically went to bed and things were looking relatively well, right? So they're gonna wake up and they're gonna think, fuck, and now what? I got 2 days where the markets are closed, and then when I wake up, I'm gonna wake up to a market, generally speaking, right, which is now 2, 3, 4, 5% lower compared to where I left it when I went to bed on a Friday, my time zone, right? So there is that component of a knee-jerk reaction at the open, right? Midnight open or Asian open, right? But then again, depends on what's going to be for the second part of the week. So I just want to see the week in its entirety before calling for a bounce or calling for a continuation. So, you're always a little bit don't want to be saying split, but, it could go both ways. So it's a 50-50 for me. Overall, I think for the rest of the week, it should keep on drifting lower. I'm just not sure on the beginning of the week. Both for gold, Bitcoin, pretty much everything across the board, even if we're looking at the other metals, right? Same logic applies. The majority of the dump, even in here, silver, it came on a Friday. The rest of the week was relatively flat. Palladium was a bit weaker, but it's been weaker for a while now. Okay, so it actually started to dump on Wednesday, if I'm not mistaken, and then it kept on going Thursday and Friday. And you know, platinum is kind of the same. Copper, although I still like copper. The fundamental thesis for it, the structure of the market, still on the bullish side of things for me. Even if we put in this temporary double top, we retrace all the way back down. I don't know, it could be even in here, right? I'll say we come all the way back in here, and we try to put together a little bit of a base, and then try again higher at a later stage, of course. But you know, wouldn't be something which would surprise me a lot. Okay, so you know, I'm not necessarily saying first that we are gonna keep on drifting lower, and secondly that even if we do, we are gonna have a bounce. I'm just saying overall, if you look at it kind of like a photograph, it's easy to say, well, copper is absolutely bullish compared to the rest, right? So that would be my take on it. And having a look at what's next, oil. Oil, do you remember last week oil was about, sure, down week, but what is the nature of range low, or this pocket of liquidity accumulated around range low as we identify it, right? Expecting a little bit of support. Lo and behold, the week starts out, and what you get, oil getting all the way back, where to? Oh, the EQ of the range. And what do you find there? Oh, a little bit of resistance, and then, you know, a temporary rejection. And I don't know why. I mean, it's responding pretty good, even to, you know, the intermediate levels in the two different halves of the range. So the bottom part and the upper part. See that? It uses that as a new launch pad for a new bounce. We completely fill this gap at this point, and then we see another rejection, and price kept on coming back lower, and we ended up the week at 90, which, you know, considering the week opened up at 88, 88.4, something like that, was pretty much unchanged for this week. If you look for a moment, if you look at the shape of the weekly candle though, looks a bit more like rejection, isn't it? Like flat bottom at the open, so no accumulation below the weekly open, goes all the way back up, and then it closes relatively near the open with a small body and a long shadow to the upside, some sort of a rejection type of candle for the weekly time frame. So this is it. Are we finally going back down, even with oil? I mean, maybe. It's not like tensions in the Middle East are completely sorted out, but, you know, at the end of the day, you could also observe that we were operating in this sort of environment, right? Lower highs on the top and higher lows. So did we crack that type of pattern, right? It was some sort of a, you know, it was going sideways. And usually when you have these type of contractions, they tend to resolve themselves on the side of the dominant trend. So trend was up, obviously. So the base case was continuation to the upside. If you like, you know, candlestick patterns, you would have expected that. And instead, what you got was a break to the downside, and now we are living below those trend lines. So confirmed break. If we get continuation at this point, one should hope that prices gets back lower. How low? Assuming they go lower, right? Well, I think the next target, if you have a move down in mind, the most recent swing low, obviously, and then probably filling in this area right here and getting back to 82, 83, something like that for the downside. The upside, I mean, assuming, you know, we resolve this situation with another bounce and we keep on staying in this range, well, sure, at this point, the upside would be obviously 100, back to range high, right? So that would be it for me, for oil. I think it's, at this point, it's just trading it like it is a range, right? Sell the highs, buy the lows, up until the point it lasts, right? And what yields, they bounced, right? So conversely, bonds, they were just faded, but got the bounce and then the fade, right? The only one interesting thing would be, I don't know if it's much more visible on the actual treasuries or the yields, but I think it's kind of the same. Well, let's pick the treasuries, all right? Now, they were all faded, right? So conversely, yield bounced, all right? Okay. But look at the 2 years, right? It went down for new lows, all right? While the 10 years didn't make new lows yet. Could be, maybe next week, all right? Sure. And not even the long bond made new lows. So if you think about the yield curve, this is not a steepener. It's not a bear steepener, right? This is actually a flattener. But if you're still in the context of bearish treasuries, right? Again, we link back to that conversation about the labor market and what could spark or not new inflation or sustainable inflation. I mean, if it is a flattener and not a steepener, this is the bond market telling you that, okay, look at the 2 years. Or maybe in the short term, we may have a little bit higher than expected rate of inflation, but over the long run, they are not pricing that in, right? It's kind of like the 2-year yield, it's going up faster compared to what the others are doing, which means yields are up in the short term, so maybe inflationary pressures in the short term, but not in the long run, right? Which is kind of the same when we were looking at these, right? What was that? The 5-year break-evens, the 10 years, and the 5-year forward inflation rate expectations, right? It's kind of like the same story. And if you look, although yields this week actually bounced, you see that all of these actually kept on coming back down. So, mixed up results. From one side of the bond market, you have yields bouncing, but this other part of the bond market is telling you, oh, well, yeah, but maybe it's temporary, right? So, take it as you like. For me, this is just another confirmation that, yeah, sure, we may see inflationary pressures in the short term. And again, when you talk macro, short term, when you say short term and people expect, if it doesn't happen in the next 2 weeks, you were wrong. Well, I'm saying short term in a macro context, it could be 6 months, right? That type of short term, right? 9 months even, right? When I'm talking long term, right? I'm not talking, and again, it's kind of the same. You say long term, 6 months, 9 months go by, it didn't happen, so you were wrong. I mean, long term could be 10 years, all right? Or could be 5 years, all right? It's basically the same argument we had when inflation or CPI was at 9%. And people were talking about, okay, now it's going to 12, 13, 14, 15. Sure, and then we need another Volcker. Did we? No, the situation resolved itself as it should be. And inflation came back down to what? 2.5? And if it wasn't for these energy crises, probably would have gotten back to 2%. Right? So who knows, right? I mean, you can't extrapolate recent price action to infinity or saying that just because something is not changing over the next 2 weeks, it's never going to change or play out, whatever, right? So, again, considering the conversations we had last week about yields and all those charts and correlation coefficients and whatnot, I wouldn't be surprised if we see yields keep on bouncing in here, and therefore bonds keep on being on the weaker side, right? But again, I'm not expecting them to really skyrocket, right? So cautiously bullish on yields, aka slightly bearish on bonds, yet, even because, look at the chart. It's hard not to be, right? It's just common sense at this point, up until the point something changes, right? But that would be it for yields, right? But you know, we may keep on looking at the oil market, which could be a contributor, maybe, but again, even this week, right? I mean, oil at the end of the day, sure, it went up and then it came back down, and yields did what? Well, they just went up. So they didn't follow the same pattern of oil. So again, little bit of a intra-week decorrelation, but again, at the end of the day, these things move hand in hand, but over months, right? Not necessarily on a week-by-week basis, right? So that would be it for now. Let's have a look at the stock market instead. And as for the stock market, there's many other things in markets. Everything looks cool, right? Up until the point it doesn't. So this week started out kind of, you know, quietly. There were a lot of data. You've seen the market. I'm looking now at ES mini futures and NQ futures, right? But you've seen the market from the weekly open, which is here, right? You've seen it going a little bit up, back down, up and down. So trading in this balance, so to speak, right? And throughout these days, of course, what we got was the ISM manufacturing and services PMI. And then we got the JOLTS, job openings, the ADP, up until the point we got to Thursday, right? Then on Thursday, right, the market actually went down and, you know, I mean, it tried to put together a rally, but it was faded, okay? And we closed the day on this bounce, but, you know, it was already starting to fade, okay? Then the market was selling off throughout Asia. It went sideways in the London session ahead of the data, right? And then the data came out and the market just shit itself, right? Now, what type of damage have we made? I mean, like we lost this balance at the top for both, right? We traded through this one tiny little shelf or balanced price segment, just shattered. And we got back to the lower side of the balance where we moved in for quite a while. I think it was from the 7th of May up to a good chunk of the month of May, all right? For both NQ and ES futures. So, you know, yeah, we did a bit of damage overall to the structure of the market. Now, when you zoom out, what you see? Again, if you remember the analogy or the logic we were using with Bitcoin, we were looking at these key swing, right? What if we try to apply the same type of analysis to especially the two major indices, right? So for ES, this would be the key swing low, which originated this move to new highs relative to here, right? Same for NQ. This would be the swing low, which originated what? This run for new highs relative to the previous highs, right? So technically, if we apply the same logic, the structure stays intact up until the point we don't violate these lows, right? And, you know, just for the sake of it, but for the Russell would be this one. Although, again, I mean, if you plot it like this, it looks like the Russell is just going sideways and going nowhere, right? But, you know, just for the sake of completeness. And for the Dow, again, the Dow was throughout the week the one which held up relatively well and better compared to anything else. So, you know, it's just going sideways in this range, while before it was going sideways in this other range in here. So it looks like no matter what, they're still auctioning it to the upside. Will it last? Will it follow the rest? Probably, if the drawdown keeps on expanding and we see farther downside, I would expect the Dow at a point to follow up. But for now, again, well, it's still hanging in there better than anyone else. Which again, it would fit, right, with the data we were looking at for the manufacturing sector. So, you know, why not? But getting back to the beginning of the conversation, up until the point we don't break these key swings, right? One should say, okay, there is still the possibility that we stay now in a range, right? In the sense that the market went up, didn't find any new buyers at these levels, and the buyers completely disappeared from the markets. All right. Is it possible that we go for something like this now, right? So some sort of a sideways action, right? Something like that. I mean, again, potentially up until the point we don't violate, especially on a closing base this low, yeah, anything can happen. On this other layout, what we see, it's kind of the same, but look, I still get back to the same topic. Monday, probably, I would expect a little bit of a continuation attempt. All right. Bear in mind, okay, that we have brought, after this huge divergence in here, right, on both, right, we were talking about the market starting to build up divergences, all right? The stochastic was giving you another one, right? Okay. And the MACD was still on a sell signal. And we said, well, look, markets are fine for now, talking about last week, right? But having a lot of divergences building up, plus the MACD on a sell signal, at the very least, you should expect limited upside. Sure, we didn't talk about a dump like this, but at the very least, you knew that you should have been a little bit on the defensive side rather than adding new positions, right? So again, as for now, we are not really seeing something which drastically destroyed the overall uptrend. We have closed below the 21 exponential, but we still have I think it's a 50 or a 55 right below it, which could, again, conditional, could provide support. If we keep on drifting, what you should see in order to really saying, you know what, maybe a correction just started, right? It's, the blue line pinching through the yellow, both downward sloped, and the blue crossing below the yellow, right? At that point, you know that your short-term trend and momentum indicators are now suggesting you to keep on being relatively bearish for the time being. I'm not, again, just pay attention to the words, for the time being. I'm not saying this is it, this is the ultimate top, we are just going down 30, 40, 50% from here. No, this is a pullback. How many times over the last month and a half, we have been talking about a market being particularly extended, all right? We were looking at all the stats for 7 weeks in a row of green candles. And then it was 8, and then it was 9. And at that point, you need to have a red candle on a weekly time frame. It's just the nature of mean reversion, right? Markets don't move in a straight line, whatever. Call it what you want, right? But this is it, all right? We were also looking at the breadth of the market. We were saying that, yes, sure, although the market was drifting higher still, but the rally was basically held together by a tiny basket of stock, while the rest of the market, and we were looking at the RSP, so the equal weighted index, it's really not following up with the same type of performances. So if those stocks crack, the entire index cracks at that point. It looks like we are looking at a small version of it. So will it be, catastrophic? Because I think sometimes it's not bad to put things in perspective. Let's take SPY, the ETF. From the lows, right? It went up something like 20%, right? Now, after a 20% run, we are now down what? 3.60, 3.50, 3.60, let's call it. Now, if you think that even a retest of previous highs, that would be just an 8% correction, and it would put you back to the 100 days simple moving average, which, if you zoom out, you see that usually when we have this sharp drop in an overall bull market, it's not a bad place to look for a bounce off of, right? So, 6, 7, 8% correction, would it be the end of the world considering where the market is coming from? No. All things considered, no. And for a minute, if you look at this, right, let's just look at basically what was holding the majority of this rally up. Semiconductors. So let's just look at the ETF. So the semiconductors ETF, look at the divergence started basically in the beginning of May, right? First one. Then you have another one in here. Same for the stochastic, all right? And same for the MACD. Look at the histogram, right? So we were pretty much deviated from long-term moving averages. So, you know, it's not unusual to come back and test at least the yellow. Can we test the green? Well, yeah, probably we could. Like if you zoom out and if you look back, it looks like the green, it's kind of where we put in all the major lows in, you know, in a huge and very lasting uptrend, right? So I wouldn't be surprised to see it coming back down a bit more, right? When you really zoom out, that's where it gets worrying a little bit. Like, look at that. Now, sure, this is a monthly time frame, and we just started the month. I'm not looking at it for the shape of the current monthly candle, but for context, let's keep on a log scale just for, all right, and let's see if we can. Okay, again, even on a monthly scale, look how many times we got back to revisit that green moving average. Those were all very good lows to be bought with a long-term goal in mind, right? At the current moment in time, right, considering we close here, we are still pretty far away from that. It's another 50%, right? Now, again, I'm not saying, obviously, that we have to go there all in one blow and therefore it would be a 50% drop, right? If we go slowly over time, the moving average will catch up. So at the end of the day, from peak to trough, it won't be a 50% drawback, but it wouldn't be out of the ordinary if you think about what we've seen in the past for these ETF. And considering that basically the majority of the gains for both, you know, NQ, of course, no brainer, but even for ES mini futures, the majority of the gains actually came from this sector, right? That one plus technology. So, you know, the market was vulnerable to something like that, which is why we kept on saying, yeah, well, if you have huge winners, this is the time to trim them down, to take the profits. It's a measure of risk management. You don't have to be short the market, but if you have something which went up 40, 50, 60%, I'm not saying sell it all, actually buy puts against it, but maybe, you know, for peace of mind, just take the profits, rebalance back to portfolio target weight, right? And this is why, because when the correction comes, you never know when it comes. You never know the exact date, but when it comes sharply, right? A few names this week were down big, right? Just for the sake of giving an example, look at AMD, ARM, ASML actually held pretty good, but Avigio, Intel, Micron, you know, Palantir, Qualcomm, the majority of the damage was done in 2 days. So it doesn't really give you a lot of time to react, right? Which is why it's sometimes, especially if you're sitting on huge gains, it's better to be proactive rather than reactive. Because when you react, or when you try to react, maybe it's too late, right? So, you know, as for, you know, the movements that we've seen, one may say, okay, but I don't understand. NFP was a blowout number. It was a very positive number. Why would the market react like that? And to me, you know, it's a bit counterintuitive if you think about that. But the premise that you have inflation derived by the situation in Iran with energy prices being a drag to the upside on inflation, all right? And now you have a job market, a labor market, which over the last 2-3 months, on paper, right, at face value, again, it's proving itself particularly resilient. And a new Fed chair, which, came in with the idea of revolutionizing the Fed, don't believe in balance sheet expansion, it would normalize interest rates and how they are managed. So one may also say, well, the market saw the numbers, they put 2 + 2 together, and they said, shit, they're not going to cut. God forbid, they may hike at this point, right? Red hot labor market, inflationary pressures for the energy crisis. And what happens if you have, in this environment, the idea that rates not only will be higher for longer, but maybe, God forbid, someone would decide to hike? A lot of the companies, especially in the Russell, they're all zombie companies. Not all per se, but a lot of them, right? They wouldn't survive. They wouldn't have survived in an environment where interest rates weren't kept artificially lower, right? What about the rest? Well, what is the industry doing with AI? They're building up the infrastructure, all right? A lot of those money were coming out of what? Cash flow. I mean, Meta, the hyperscalers, Meta, Google, Microsoft, they do have it. They have it before and they still have it. A lot of cash flow, right? But at a point, the expenses for these build out were so high that they had to do what? Go into debt, which is normal. I'm not advocating against debt. I don't think that debt it's the devil necessarily. If it is productive debt, then so be it. It's welcome, right? If the marginal utility that you get from what you're financing with that debt, it's higher than the cost on that loan, you should just go and do it, right? It's an investment at a point. But the point is that since those companies are now going into debt to finance the build out, what happens if you have more debt than before? A chunk, which could be tiny, could be huge, depends. It's just the idea that a chunk of the dividends or the payoff, whatever, or the cash flow of the company from here on out, instead of being distributed or reinvested, should be allocated to service the debt. So lower what? Lower earnings. And it might be marginal, but the simple idea of that in an environment where as we've seen, you got earnings projections going up and up and up and up, might be that someone thought, wait, is this what breaks the back of earnings only going up, right? And then we've seen, I think it was, I don't have the article at hand now, but I think it was a CNBC where Meta said that they are thinking about selling more shares to finance the build out of their AI infrastructure. What does it mean? So you don't want to go in the bond market to finance yourself? Are you diluting shareholders, selling more shares to finance the investments? And the shareholders said, you know what? Thanks, but no thanks, right? Don't want to be diluted. And, you see Meta is doing it, and you start to think, wait, what if all the others start to do it? So, again, it may just be a knee-jerk reaction. As we often said, you just need a catalyst, right, to break a situation which is getting more and more fragile, underlying, right? So it may be that this was it. That was the catalyst, which, the NFP, right, the labor market, which triggered all this thought process, which led people to think maybe these stocks are not fairly valued for what we think it may come out of this week of macroeconomic data, plus what the company said, plus how yields are moving. It's never just one thing, right? It's always a combination of a few things. Plus, on top of that, you could put, I think I actually have a few slides for it, but, you could put market dynamics as for, the gamma exposures, which, it's like adding leverage to the system. It works well up until the point it works to the upside, but it works in reverse when you reach that point, which is usually defined as, I think, gamma flip, right? Where the gamma transition from being, negative on the side of the sellers this time. So if before the gamma squeeze was to the upside and dealers had to buy in the underlying to keep on hedging themselves, at a point, if that flips and now dealers needs to keep on selling in order to be hedged, they are going to exacerbate the move to the downside in this case. So same principles, but different direction, right? Now, after all of that, to kind of recap a few concepts and visualize them better, I mean, look at that. When we talk about the breadth of the market, right? So this is year to date, right? And this is basically all the different sectors. And you got the S&P in black, it looks like, right? Which would be this one. Sure, it's going up, but look at the other sectors. And, something like XLK, which is in pink or purple, whatever, it's making the majority of the lift. So again, breadth, XLE, which went up, of course, after what happened at the beginning, at the end of February, it went up, but then it basically went nowhere. So again, an initial contribution from the energy sector, but the majority of the lift was made by technology. I mean, again, it's no mystery. I'm not telling you anything you didn't already know, right? And then what? Okay, now, do you remember we were looking at SMH, so the ETF, and, in here they're talking about the deviations in between the current price action, although this is updated to the end of May, I think. So we got another week of trading in between, and the 15-month moving average. So again, if you get back in here, you take this one, you take the monthly chart, which would be this one, and you think of where the 50 simple moving average on the monthly time frame would be. Probably around here, I guess. Green is a 55, but it is exponential, so maybe the simple would be a bit lower than that. And they were measuring, 168 deviation above it. Which again, just to give you a testimony of the rate of extension that sector actually faced throughout these recent times, right? Now in here we got what? I mean, again, if you think about what goes into semiconductors, the thing is that a lot of semiconductors, they're all dependent on the same 5 buyers. So these are the hyperscalers, right? They're all putting together the capex, and then they are, spending this money to all these guys. Now the thing is that the hyperscalers, they can shift their spending to someone else. Like, let's say, if in the future you see a new participant, a new player in the semiconductor game, I mean, Google could say, you know what, I was giving XYZ amount of billions to Broadcom. This other guy makes better chips, so I'm going to give them to him. So Broadcom will lose what? A buyer, right? So the hyperscalers can switch from one supplier to the other. The semiconductors producers, they don't. So they're all dependent on what's going on the buyer side, right? Now, sure, NVIDIA most likely will retain the dominance for now, but the thing which makes fragile, even on a fundamental base, what we are looking at in the semiconductor space is also this. Now, for instance, if I think it already happened to some degree, obviously, but if for some reason we find out that now that we have the chips, right, in order to build up these platforms, we need to pair these chips with faster and much more efficient memories, what's going to happen? I already spent for the chips I needed. now maybe I need to spend for the memories, which is why, again, you've seen SanDisk or Western Digital having these type of runs. So it's always a matter of where the money is flowing toward and at what time, which oftentimes dictates which sector or which stock will perform relatively better than another or relatively worse. And in this thing, right, in this modern era of AI and technology, it changes on a dime, right? So, I mean, you really need to keep on sticking to it if you want to be nimble enough to embrace the change, so to speak, all right? Then what? While we were talking about the gamma squeeze, this is just, a schematic, all right, of how the squeeze feedback loop actually works, right? Not gonna discuss a lot. It's pretty self-explanatory. This is just a schematic of it. Since we were discussing it before, right? This is it. And again, this is something else which contributed to something like this being able to make a run like that. So, I mean, if you get back on the daily time frame, this type of run right here. I mean, it is fundamentally justifiable. Probably yes. Did this play a role? Absolutely yes. Probably played the majority of the role in that run. So when it gets reversed, you see the unwind of the positions and the entire dynamic shifting to the opposite side. Again, leverage cuts both ways, right? Then was sticking to semiconductors. I mean, again, just for the sake of it, I was fantasizing about potential pullbacks to these moving average or the other, and I was like, well, 50%, it's kind of a lot. Well, I mean, if you look in the past, from peak to trough, I mean, 50%, it's not out of the ordinary, right? 2008, 2022. I mean, .com was a little bit on the extreme, but, 30, 34. So don't discard that things could get a little bit more spicy there, right? Now, as for the S&P in general, a little bit of a frame of reference. I know it's a little bit tiny. Maybe you're not going to be able to read it on screen, but let's try to zoom in. So this is basically, all the corrections, the 10 to 20% corrections, and what happened after that, in the sense, what type of a bounce we had in the aftermath of that, from basically World War II to present day. And you see, the average correction, the average time to reach the low, and, the median rally from the low to the next peak, and the length of that rally. So how much overall, on average, the market dropped, how much it took it to drop from peak to trough, and how much it took it to recover completely, and what type of extension we had to the upside when we bottom out and we made a new peak, right? And again, there are a lot of data right here, trying to go slow enough so that if you are just pausing the video while I scroll, you may be able to look at a few data here and there, but these are all publicly available data, so it's not that I'm not revealing some sort of industrial secret, right? So again, when people tells you that, well, I mean, if the market is going to correct from current levels, 6, 7, 8, God forbid, 10%. Oh, I mean, the market is crashing. As you just seen, it's something which happens relatively, often. Actually, you have a 10-ish% correction every single year, right? This year alone, I mean, if you think about the war and when it started, we got 10% correction, right? 2025, with tariffs and all the rest, we got a 20% correction. Now, the thing may be, with the fact that we already had our 10% correction this year, could this be to, in order to match the statistical reality, this correction, assuming this is the actual unfolding of one, it's not going to be, it's going to be, it's not going to be as severe. Hence the slippery tongue, severe be beer. I'm always thinking about beer, right? But sure, maybe not. Well, we already had that 10%, so maybe this one is going to be less than 10%. Who knows, right? But just, even if it's not 10% or more, it's going to feel a hell of a lot worse than what it really is in reality when you look at the market. Again, for the futures, getting back to the old highs, it's 7.77% correction. It's basically not a lot. And if anything, if you do believe still in the infrastructure build out for AI, if you still believe that the labor market, whatever we may say about it, is still resilient, if you still believe that no matter the K-shaped economy, overall, the stock market should track the aggregate, the overall, and growth, it's still pretty much good for the rest of the year. If you believe all those things, if you have your stats, your strategies, and your reasons to believe that, this may be a good buy the dip opportunity. Pair it up with seasonality. We are getting into the weaker period of the year and of the 4-year presidential election cycle. So, from here to, I don't know, the next 2 months, 3 months, if you have something that you would like to buy, to then see the market recovering and getting in the stronger period of the year, so October, November, December, you may be able to buy it at a discount right now. So take out your wish list if you think we are on that path, right? But don't forget overall that, look, it's easy to say, on a year-over-year base, these are the returns for the stock market, all right? Sure. What they don't tell you is that although from the 1st of January to the 31st of December, the market sure will make 20, 26, 14, 23, 13, whatever. There is still intra-year volatility. Just, as an example, even on, 1998, all right, but even in a year when the market closed at the end of the day, 27% up for the year, we got a 20% correction, right? Or, it's full of examples, of course, but this one right here, I guess it was 2023, the market was up what? 24%, and we got a 10% correction. 2025, the market was up at the end of the day, 17% for the year, and we got what? A 19% correction. So, one thing it's saying, yeah, I'm just going to invest and sticking to it and believing in the long term, although, 1 year, can you really call it long term? Yeah, sure. But then when you have to face these type of drawdowns, all those plans, all those things, all those convictions, they are put to a test, right? All right. Then again, before this dump, and again, this was taken before, but again, the imbalance in between the positioning, right? When you look at the some sort of a put to call type of ratio, but basically the retail activity in the option market, right? There was a huge imbalance. Right? Everyone were buying calls, believing in more upside, and nobody was buying puts, aka insurance. And as is often the case, people don't buy insurance at the moment they would need it the most. And at the moment, ironically, when it's much cheaper than in other times, right? So again, this is it. Now, finally, just for a laugh, on a closing, on an analog, right? I don't believe in analogs as a general rule of thumb, although, it was really crazy. And actually, probably it's not going to play out the same, but I'm not going to hide behind a finger and saying this is to some degree what I would expect over the coming years, right? Which is this. Basically, the current, so to speak, bubble compare to the .com. So, if you think about the .com from 1995 up to the 2000s, right? look in those 5 years, how many times the market tanked and then recovered. It tanked and it recovered. And then it tanked again and it recovered. And after this huge tank, right, in 1998, that was the parabolic phase of the rally. So again, this is why when you see something like a 6, 7, 8, 10% correction, I mean, it's not that which really mark the end of the cycle. I don't know, to some degree, I always like the good old saying that the party always gets louder and louder before the cops show up, right? Are we there yet? I don't think so. Could we see a pullback in here? Yeah, again, a lot of reasons to see a pullback throughout the summer. It is the end of the bull market. It is the floodgate opening for the next 40, 30, 50% correction. I don't believe so, right? So navigate this pullback. You had all the elements to put your portfolio, in a safe type of position if you wanted to listen. And, this is the time where you built up that cushion of cash and now you go shopping. Again, try to time the shopping carefully because, it's not just like the market dips one day for an hour, you buy and it goes up and up only. No, but, there might be opportunities if the market provides them. Sure as hell, over the last 2 months, the market was rewarding enough. So whether this is a correction or this is just the market taking a break and going sideways, embrace it. Because as usual, markets can correct in two ways, either by dumping or by going sideways. So navigate it for what it is. Don't panic out. Don't run for the hills, right? And just live through it for what it is. It's just another market phase. There's nothing yet, if any, if it should be in the future, but for now, absolutely, there's nothing to panic out about, right? And listen, if things get really grim, I'll come back here and saying, you know what? Now it's the time to really be worried, right? Okay? But for now, I don't see it yet, right? So that would be it for this week. Kind of happy. I kind of made it in a reasonable amount of time. So now I can dedicate the rest of the afternoon to the preparation of the big dinner, family, birthday, BBQ and whatnot. Beside me, which probably going to be particularly hangover tomorrow morning. But as for you instead, as usual, be nice and be cool. Keep on being sharp. Keep on being nimble. Don't panic out. And we will check in next week. Knees out.
Mm-hmm. Mm-hmm. Mm-hmm.